Getting a mortgage can seem like a daunting task, especially if you're new to real estate or just trying to buy your first home. As you probably know, a mortgage is a loan specifically designed for purchasing property. The unique thing about mortgages is that they are secured by the property itself, which means that if you fail to make your payments, the lender has the right to take ownership of your home. This might sound scary, but it's simply the way the lenders protect themselves. Mortgages typically last anywhere from 15 to 30 years. During that time, you'll make regular payments, which include both the principal, the amount you borrowed, and the interest, the cost of borrowing the money. By the end of the loan term, the property is yours, free and clear. Why mortgages are crucial in real estate investing? If you're considering getting into real estate investing, mortgages are your ticket to building wealth. Mortgages allow you to leverage the bank's money to purchase properties that would otherwise be out of your financial reach. This leverage is powerful because as the property appreciates in value, your equity, the portion of the property you truly own, grows, and so does your wealth. For instance, let's say you buy a property for $300,000 with a 20% down payment. That's $60,000 of your own money and $240,000 from the bank. If the property increases in value by 10%, it's now worth $330,000. Your equity has grown from $60,000 to $90,000, even though you only invested $60,000. This is how real estate investors build wealth over time, using mortgages to amplify their returns. Types of mortgages. Choosing the right mortgage is crucial as it affects your monthly payments, the total interest you'll pay, and your overall financial strategy. Fixed rate mortgages. A fixed rate mortgage is the most straightforward option. The interest rate stays the same for the entire term of the loan, whether it's 15, 20, or 30 years. This stability means your monthly payments are predictable, making it easier to budget. If you take out a 30-year fixed rate mortgage at 6.5%, you'll pay the same interest rate for the entire 30 years, regardless of what happens in the economy. This makes fixed rate mortgages a popular choice for people who plan to stay in their homes for a long time and prefer the security of knowing exactly what their payments will be. Adjustable rate mortgages. An adjustable rate mortgage, ARM, starts with a lower interest rate than a fixed rate mortgage, but that rate changes over time, usually after an initial period of 3, 5, or 7 years. After this period, the rate adjusts periodically based on a specific index or benchmark. For instance, you might get a 5-1 ARM, which means you'll have a fixed interest rate for the first 5 years, after which the rate adjusts every year based on the market. They can be a good option if you plan to sell the property or refinance before the rate adjusts. However, they carry more risk as your payments could increase if interest rates rise. FHA loans. If you're a first-time home buyer or have a lower credit score, an FHA loan might be a great option. They're backed by the Federal Housing Administration and require a lower down payment, often as low as 3.5% of the purchase price. Additionally, FHA loans are more forgiving of credit issues, so if your credit score isn't perfect, you may still qualify. For example, if you're buying a $200,000 home with an FHA loan, you might only need a down payment of $7,000. This makes homeownership more accessible for people who haven't had the chance to save up a large sum of money. VA loans. If you're a veteran, active duty military, or a surviving spouse, you may qualify for a VA loan, which is backed by the Department of Veterans Affairs. VA loans offer some of the most favorable terms out there, including no down payment and no private mortgage insurance, PMI. The VA also limits the amount you can be charged for closing costs, which can save you a significant amount of money. Jumbo loans. For those looking to buy high-value properties, a jumbo loan might be necessary. Jumbo loans exceed the conventional loan limits set by Fannie Mae and Freddie Mac, making them the go-to option for luxury homes or properties in expensive markets. However, because they involve more risk for the lender, jumbo loans typically have stricter credit requirements and higher interest rates. Key features of a mortgage. Interest rate. The interest rate determines how much you'll pay in interest over the life of the loan. A lower interest rate can save you tens of thousands of dollars over time. Loan term. The loan term is the length of time you have to repay the loan. Common terms are 15, 20, and 30 years. A shorter loan term will result in higher monthly payments but less interest paid overall, while a longer term will mean lower monthly payments but more interest over the life of the loan. Down payment. Your down payment is the upfront cash you paid toward the purchase of the property. While some loans like FHA and VA loans require low or no down payments, a larger down payment can reduce your interest rate and eliminate the need for a PMI. Private mortgage insurance, PMI. If your down payment is less than 20%, you'll likely need to pay PMI, which protects the lender if you default on the loan. PMI can add a significant amount to your monthly payments, so if possible, aim to put down at least 20% to avoid this extra cost. Different types of lenders. Choosing the right lender is just as important as choosing the right mortgage. Different lenders offer different products, rates, and levels of customer service, so it's worth shopping around. Banks. Traditional banks are a common choice for mortgages. They offer a wide range of products, but their requirements can be more stringent. Big banks like Wells Fargo, Chase, or Bank of America have well-established mortgage programs, but may not offer the most competitive rates. How to get started. Start by calling your bank or visiting their website to explore mortgage options. Tell them you're interested in exploring mortgage options and want the rates and terms available for someone in your financial situation. Banks will likely ask for your financial details up front to offer you a rate quote. They may have stricter requirements, so be prepared with your credit score and income details. Credit unions. Credit unions are member-owned institutions that often offer lower rates and fees than traditional banks. Because they're not for profit, they can pass savings on to their members. If you're eligible to join a credit union, it's worth considering. How to get started. Search online for credit unions in your area or ask friends and family for recommendations. Credit unions may have more flexible requirements and could offer personalized service. They might also have special programs for first-time buyers or lower fees. Mortgage brokers act as intermediaries between you and the lender. They can help you find the best rates by comparing offers from multiple lenders. This can save you time and potentially get you better terms than if you went directly to a bank or credit union. How to get started. Look for mortgage brokers in your area or reputable online brokers. Tell them you're looking to secure a mortgage and would like to compare different lenders and want to find the best deal. A broker will likely ask for your financial information to shop around on your behalf. They can earn a commission from the lender, so ensure they're working in your best interest. Consider United Wholesale Mortgage, UWM, for quick competitive options and Guaranteed Rate for balanced pricing and personalized service through brokers. Online lenders. In the digital age, online lenders like Rocket Mortgage or LendingTree have become increasingly popular. These platforms allow you to apply for a mortgage online, often with a quicker and more streamlined process and competitive rates. How to get started. Go to platforms like Rocket Mortgage, LendingTree, or Better.com and enter your information for a quick rate quote. These sites often have calculators that let you see what your monthly payments would be. Online lenders can provide fast pre-approvals, but make sure you compare their offers to those from banks and credit unions. Look out for any hidden fees or conditions. How to get a mortgage. Now that you understand the basics, let's go through the steps of actually getting a mortgage. Step 1. Check your credit score. Your credit score is a critical factor in determining your mortgage rate. The higher your score, the lower your interest rate will likely be. If your score is below 620, you might want to spend some time improving it before applying for a mortgage. This could involve paying down debt, correcting errors in your credit report, or simply making sure all your bills are paid on time. Where to check? Free credit report sites. Websites like annualcreditreport.com or Credit Karma allow you to check your credit score for free. What to do if it's low? If your credit score needs improvement, consider strategies like paying down high-interest debt, disputing errors on your credit report, or setting up automatic payments to avoid missed bills. Step 2. Get pre-approved. Before you start shopping for homes, it's best to get pre-approved for a mortgage. This involves submitting your financial information to a lender who will then give you a pre-approval letter stating how much they're willing to lend you. This letter shows sellers that you're serious and gives you a clear budget to work with. How to get started. Contact a lender or use an online platform to apply for pre-approval. Tell them you're planning to buy a home and want to get pre-approved for a mortgage. Lenders will ask for income verification, tax returns, and bank statement. Pre-approval usually takes a few days, and having this in hand will strengthen your position when making offers on a home. Step 3. Save for a down payment. While it's possible to get a mortgage with a low down payment, the more you can put down, the better your terms will be. Aim for at least 20% if possible, as this will help you avoid PMI and lower your monthly payments. Step 4. Shop around for the best rates. Compare rates from different lenders, including banks, credit unions, and online platforms. Even a small difference in interest rates can add up to significant savings over the life of the loan. Where to look? Use comparison websites. Sites like Bankrate or NerdWallet allow you to compare mortgage rates from multiple lenders at once. When you call or apply online, say, "I'm comparing rates from several lenders. Can you offer any rate discounts or incentives?" Some lenders might offer rate discounts, especially if they know you're shopping around. Be sure to ask about all associated fees to get a complete picture of the costs. Step 5. Prepare your documents. When you apply for a mortgage, prepare your documents. Income verification. Collect recent pay stubs, W-2 forms, and tax returns. Bank statements. Have copies of your bank statements from the past few months. Additional documents. Be ready to provide proof of any other assets, such as investment accounts or retirement savings. What to do if you don't qualify? If you don't qualify for a mortgage right away, don't get discouraged. There are steps you can take to improve your chances. Improve your credit score. If your credit score is the issue, focus on improving it. This might mean paying off credit card debt, making sure all your bills are paid on time, or even getting a secured credit card to build up your credit history. Steps to take. Pay down debt. Focus on paying off high-interest credit cards first. Set up automatic payments. Ensure you never miss a bill by setting up automatic payments through your bank. Dispute errors. If you find errors in your credit report, dispute them with the credit bureau to potentially boost your score. Increase your income. If your debt-to-income ratio is too high, consider ways to boost your income. This could involve taking on a side hustle, asking for a raise, or even taking on a roommate to reduce your housing costs and free up more money for savings. Take on a side gig. Consider freelance work, part-time jobs, or gig economy opportunities. Reduce expenses. Look for ways to cut back on unnecessary spending, such as dining out less or canceling subscriptions you don't use. Consider a cosigner. If you're struggling to qualify on your own, a cosigner with strong credit might help you secure a mortgage. Just be sure that both you and your cosigner understand the responsibilities involved. Who to ask? Reach out to trusted family or friends. A parent or close relative is often a good choice for a cosigner. Ask them if they would be willing to cosign your mortgage and explain that you'd be responsible for all payments. Look for assistance programs. Many states and local governments offer down payment assistance programs, grants, or low-interest loans to first-time homebuyers. These programs can make a big difference, so it's worth researching what's available in your area. Where to search? Check state and local government websites. Look for first-time home buyer programs in your area. What to do? Apply early, as these programs often have limited funds and can be competitive. Alternatives to traditional mortgages. If traditional mortgages aren't an option, there are alternatives that might work for you. Owner financing. In some cases, the seller might be willing to finance the purchase directly. This means you make your mortgage payments to the seller rather than a bank. Owner financing can be more flexible, but the terms may vary widely, so it's important to get everything in writing. How to find these deals. Search for owner finance properties. Start with a real estate site like Zillow's FSBO section, zillow.com/homes Realty.com/FSBO. Seller financed homes can be tricky to find as they are often arranged on a case-by-case basis. This means you'll typically need to contact the seller directly to discuss financing options. When reaching out to a seller, you can ask, "I'm very interested in your property and wanted to know if you'd consider owner or seller financing. I'd love to discuss how we could structure a deal that works for both of us." This opens the conversation and shows you're flexible and willing to explore different options. Other resources. Talk to local realtors, as they may have connections to sellers who are open to owner financing but haven't advertised it publicly. Additionally, consider joining local real estate investment groups where owner finance deals are often shared among members. Rent to own. With a rent to own agreement, you rent the property with the option to buy it later. Part of your rent payments might go toward the purchase price. This can be a good option if you need to save for a down payment or improve your credit. How to search. Look for rent-to-own listings. Sites like Rent-to-Own Labs or local real estate listings can help you find these opportunities. Ask them, how much of my rent will go toward the purchase price, and what's the timeline for buying the property? Hard money loans. These are short-term loans from private lenders, often used by real estate investors to finance renovations. They typically have higher interest rates, but can be easier to qualify for if you have less than perfect credit. Where to find them? Search online for hard money lenders. There are a number of hard money lenders, including companies like Jet Lending or Kiavi, and sites like BiggerPockets can be a good resource to connect you with lenders. Ask them, what are your terms and what fees are involved? Can you walk me through the process of securing a hard money loan? Mortgages for rental properties. If you're looking to buy a rental property, the mortgage process is slightly different. Investment property loans. These loans are designed for buying rental properties. They usually have stricter requirements and higher interest rates compared to primary residence mortgages. Lenders see investment properties as riskier, so they'll often require a larger down payment and higher credit score. How to get started. Contact lenders, speak to banks, credit unions, or mortgage brokers about your plans to invest in rental properties. Ask them, what are your requirements for investment property loans, and what down payment would you recommend? Cash out refinancing. If you already own a property, you can refinance your mortgage and take out cash to purchase additional properties. This strategy can be a great way to leverage your existing equity to grow your real estate portfolio. How to get started. Talk to your current lender. Ask about the possibility of a cash out refinance. What to say? I'm interested in a cash out refinance to fund the purchase of additional properties. What are the current rates and terms? Portfolio loans. If you plan to own multiple rental properties, a portfolio loan might be a good option. This type of loan allows you to manage several properties under one loan, which can simplify your finances and potentially lower your overall costs. How to get started. Speak to specialized lenders. Search for lenders who offer portfolio loans for real estate investors. Ask them, can you explain how your portfolio loans work and what the benefits are for managing multiple properties? Current mortgage situation in 2024. Finally, let's talk about the mortgage landscape in today's market. Interest rates. As of 2024, mortgage rates have stabilized around 6 to 7% depending on the lender and your credit worthiness. While these rates are higher than what we saw a few years ago, they're still manageable for many buyers, especially if you shop around for the best deal. And rates are expected to decrease in the near future. What to do? Stay informed. Keep an eye on economic news and updates from the Federal Reserve, as these can impact mortgage rates. Where to search? Use rate comparison websites like Bankrate to stay updated on current mortgage rates. Housing market conditions. The current real estate market is expected to remain competitive, with inventory shortages continuing to drive prices up in many areas. However, there are still opportunities for investment, especially in emerging markets or areas that haven't seen as much price appreciation. What to do? Research market trends. Use tools like Zillow's research, housing data, and market reports, or local real estate news to understand where the opportunities are. Who to contact? Consider reaching out to a real estate agent who specializes in investment properties for advice on the best areas to invest in 2024. Government programs. The federal government continues to support homebuyers through programs like FHA loans and VA loans. There's also talk of new initiatives aimed at addressing affordability issues, so it's worth staying informed about any changes that could benefit you. What to do? Check for updates. Visit the U.S. Department of Housing and Urban Development, HUD, website for the latest on federal homebuyer programs. Who to contact? If you're unsure about eligibility, consider speaking with a HUD-approved housing counselor who can guide you through available options. Conclusion. Getting a mortgage in today's market might seem challenging, but with the right knowledge and preparation, you can navigate the process with confidence. Whether you're buying your first home or adding to your investment portfolio, understanding your options and taking proactive steps will put you on the path to success. Don't be discouraged by challenges like higher interest rates or stricter lending criteria. By following steps outlined in this guide, you can secure a mortgage that fits your needs and helps you achieve your financial goals. Remember, the key to getting a mortgage is preparation. Check your credit score, save for a down payment, and shop around for the best deal. Soon you'll be signing those closing papers, holding the keys to your new property, and becoming a Realty Rockstar. Share and subscribe.